Hey everyone. So I was actually talking with a client yesterday about different real estate tax strategies, and we started talking through the cost segregation study. And I figured it would be good to talk about it in a video for more people to hear about. So, yeah, today we're going to talk about cost segregation. So let's break it down what it is, how it works, give you guys an example as always, and then some considerations. So, firstly, what it is, it's paying an engineering based firm or a cost segregation study firm to break down your property into shorter lived components. We talked about in another video about how residential real estate, the asset life is 27 and a half years. And if you pay someone to go and break down the different parts of the house, think about appliances, carpet, wall, landscaping, they'll find that some of those lives are actually 5 years, 10 years, 15 years. And then what you do is you depreciate those parts faster, which means bigger tax deductions up front. So, how do you actually do a cost segregation study? So, this isn't something that you can do yourself. You have to get a separate firm to actually do the study and then report to your CPA. And then your CPA will update your depreciation schedule using what is called a Form 3115. The actual cost is around 5 to 10,000 for a single family home, and that's just a starter price. If you're gonna cost segregate a apartment building or even a duplex, or the price goes up from there. So you have to definitely talk with your CPA and make sure that if you're going to spend that much money, that it's worth it with the deductions on the back end. So let's say Alan, he buys a rental property for $300,000, and the depreciable base after accounting for land is $250,000. So with regular depreciation, if we were to divide that 250,000 by 27 and a half, that would be around $9,000 per year. But with a cost segregation study, we find that 50,000 of that property can be depreciated in 15 years or less. And we can write off all 50,000 in the first year. So it's a $41,000 swing in year one from 9,000 to 50,000. As always, there's some considerations you have to take in with depreciation recapture. If you ever choose to sell the property, you could have to pay some of that benefit back. Another thing is that it could be subject to passive loss rules. So if you don't have any other rental income or other passive activity to offset it with, you can't take that full 50,000. There is a cost for the study, and not only the cost for the study, you're going to have to pay much higher price to your CPA. This really does work best if it's used in conjunction with a real estate professional status or the short-term rental loophole, as well as 100% bonus depreciation strategies, which with the One Big Beautiful Bill Act just came back on the table. So as a conclusion, it's a powerful strategy for real estate investors. It allows you to free up cash to maybe invest in the next property or just have cash for other opportunities. Talk with a CPA who understands real estate, and let me know if you have any questions or want to talk through your specific situation. Thank you.